Imagine waking up 10 years from now. The alarm goes off. You drag yourself out of bed. You check your bank account, and nothing has changed. You're still living paycheck to paycheck. Still stressed about bills. Still wondering where all your money went. Now imagine someone else. Same age as you. Same starting point. But 10 years ago, they made one small decision. They started investing just $100 a month. And today, they're quietly sitting on a portfolio worth hundreds of thousands of dollars. Not because they were smarter, not because they earned more, but because they started. That gap between the person who waits and the person who acts is not luck. It is not talent. It is one decision made early enough to matter. And today, in this video, I am going to make sure you become the second person. Here is the uncomfortable truth. Millions of people, students, young professionals, people just like you, want to invest. They know they should do, but they never begin. Why? Because the moment you type how to invest into Google, you are hit with a wall of confusing terms. Stocks, bonds, ETFs, mutual funds, Roth IRA, expense ratios, dividends, market cap. It feels like you need a finance degree just to open an account. So people do what feels safe. They wait. They tell themselves, I'll figure it out later. I'll start when I have more money. I'll start when I understand it better. But here is what nobody tells you. Waiting is not safe. Waiting is actually the most expensive financial mistake you can make. Because the one resource that makes investing work, time, is the one thing you can never get back. Every year you delay costs you thousands of dollars in lost compounding growth. We will talk about exactly what compounding means in a few minutes, and when you see the numbers, it will change the way you think about money forever. Real quick, before we go any deeper, if you want simple, clear strategies that help ordinary people build real wealth step by step, follow Infinity Wealth right now. We break down complex financial topics into plain English every single week. Hit follow so you never miss a video. Alright, let's get into it. Most people think investing starts with picking a stock. It does not. Investing starts with building a financial foundation. And there are 3 pillars to that foundation. Pillar 1, the emergency fund. Life is unpredictable. Your car breaks down. You lose a job. A medical bill shows up out of nowhere. Without an emergency fund, when these moments hit, you are forced to do the worst possible thing. Sell your investments at exactly the wrong time, locking in losses just to cover the crisis. Your emergency fund is not an investment. It is a shield. It protects everything else you are building. Financial experts recommend saving 3 to 6 months of your living expenses in a high-yield savings account before you invest a single dollar in the market. Think of it this way. You would not build a house on sand. Your emergency fund is the concrete foundation everything else sits on. Pillar 2, control your high-interest debt. This one surprises a lot of beginners. If your credit card is charging you 20% interest every year, but your investments are returning 8%, you are mathematically going backwards. You are losing 12% every single year. Paying off high-interest debt first is not being boring. It is actually one of the highest return financial moves you can make. Once that debt is gone, every dollar you redirect into investing starts working for you instead of against you. Pillar 3, create your monthly investing surplus. This is the money left over after your bills, your needs, and your emergency fund contributions. Even if it starts at just $50 or $100 a month, that number matters more than you think. Do not wait until you have a lot of money to invest. Start with what you have. The habit is more valuable than the amount in the beginning. Now that your foundation is set, let's talk about where your money actually goes. When most people hear investing, they immediately think stocks. And yes, stocks are one of the most powerful wealth-building tools ever created. When you buy a stock, you are buying a small piece of ownership in a real company. If that company grows and becomes more valuable, your piece becomes more valuable too. But here is where beginners make a critical mistake. They try to pick individual stocks, jumping on whatever is trending on social media, whatever some influencer on Twitter is talking about. And the painful reality is even professional fund managers with teams of analysts and decades of experience fail to consistently beat the market. So, what should a beginner do instead? Index funds. This is where your journey should begin, and honestly, for most people, this is where it should stay. An index fund is a single investment that holds hundreds or even thousands of companies all at once. When you buy one share of an S&P 500 index fund, you are instantly invested in 500 of the largest companies in America: Apple, Microsoft, Amazon, Google, all of them in one purchase. You are not betting on one company. You are betting on the entire economy. And historically, the economy has always gone up over time. The other massive advantage of index funds is cost. They are passively managed, which means their fees, called expense ratios, are tiny, sometimes as low as 0.03% per year. Compare that to actively managed funds that charge 1 to 2% and still underperform. Lower fees mean more of your money stays invested and keeps compounding. And speaking of compounding, let's talk about the concept that Albert Einstein reportedly called the eighth wonder of the world. Compounding. This single concept, once you truly understand it, will change your relationship with money forever. Here is how it works. You invest $100. It earns 10%. Now you have $110. Next year, that 10% return is calculated on 110, not just the original 100. So you earn $11 instead of 10. The year after that, you earn even more. Your returns are earning returns. It sounds small at first, but give it time and the numbers become almost unbelievable. Let me show you the power of starting early. If you are 20 years old and you invest just $200 a month at an average annual return of 8%, by the time you are 60, you will have accumulated over $700,000. More than $500,000 of that comes not from your contributions, but from compounding alone. Now here is the painful flip side. If you wait just 10 years, starting at 30 instead of 20, that same $200 a month grows to roughly $300,000 by 60. You invested the same amount. You followed the same strategy. But waiting 1 decade cost you $400,000. Time is not just a factor in investing. Time is the investment. Now I want to give you the single most powerful beginner strategy in investing. And it is not about picking the right stock. It is about removing the pressure of picking the right time. It is called dollar cost averaging. Here is how it works. Instead of trying to time the market, waiting for the perfect moment to invest all your money at once, you invest a fixed amount every single month, no matter what the market is doing. When the market is up, your fixed amount buys fewer shares. When the market is down, your same fixed amount buys more shares at a discount. Over time, this evens out your average purchase price and actually turns market dips into your advantage. This strategy removes one of the biggest obstacles for beginners: fear. The fear of investing at the wrong time. The fear of the market crashing right after you buy. Dollar cost averaging makes that fear irrelevant because you are not trying to time anything. You are simply staying consistent. Set it up automatically. On the first of every month, a fixed amount leaves your account and goes straight into your index fund. You do not think about it. You do not check the news. You do not panic. You just stay the course. This is what discipline looks like in investing. And discipline, over time, beats almost every other strategy. Here is something the financial industry does not talk about enough. The math of investing is actually the easy part. The hard part is the psychology. Markets crash. They always have. In 2008, markets dropped over 50%. In 2020, markets dropped 30% in a matter of weeks. When something like that happens, your portfolio turns red, the news goes into panic mode, and every instinct in your body screams, sell everything and get out. And that is exactly the moment that separates wealthy investors from everyone else. Every single market crash in history has been followed by a recovery. Every single one. The investors who stayed the course, kept contributing, and did not sell in panic, they're the ones who came out on the other side significantly wealthier than before the crash. The investors who panic sold? They locked in their losses, missed the recovery, and paid the price for years. The market is not your enemy. Volatility is not a bug, it is a feature. It is the price you pay for the extraordinary long-term returns that no savings account or fixed deposit will ever give you. When markets fall, do not run. If anything, celebrate, because your monthly dollar cost averaging just bought you more shares at a discount. You are getting the same companies at a sale price. Stay consistent. Stay calm. Think in decades, not days. All right, let's make this real. Here is exactly what you need to do to start investing in 2026, step by step. Step 1. Build your emergency fund first. 3 to 6 months of expenses in a high-yield savings account. Do not skip this. Step 2. Pay off any high-interest debt above 15% interest. Credit cards, payday loans, eliminate these first. Step 3. Open an investment account. In the US, this means a Roth IRA if you are eligible. Your money grows completely tax-free. Or a standard brokerage account through platforms like Fidelity, Schwab, or Vanguard. All three are trusted, low-cost, and beginner-friendly. Step 4. Choose a low-cost index fund. Something that tracks the S&P 500 like VOO, SPY, or FXAX. Do not overthink this. Pick one and start. Step 5. Set up automatic monthly contributions. Even $100 a month. Make it automatic so it happens without you having to decide every month. Step 6. Do not touch it. Leave it alone. Check it quarterly if you must. But do not react to daily market moves. Think in year. Think in decades. That is it. 6 steps. No complexity required. The most sophisticated thing you can do as a beginner is keep it simple and stay consistent. Let me leave you with this. The biggest difference between people who struggle financially for decades and people who build real, lasting wealth is almost never income. It is almost never intelligence. It is one decision, the decision to start. You do not need a lot of money. You do not need a finance degree. You do not need perfect timing. You just need to begin, and then stay consistent long enough for compounding to do its work. 10 years from now, you will either look back at this moment as the day everything changed, or the day you almost started but didn't. That choice is entirely yours. If this video gave you clarity, if it made investing feel possible for the first time, please hit that like button right now. It genuinely helps this channel reach more people who need this information. Subscribe to Infinity Wealth and turn on notifications, because every week we are dropping videos just like this one. Simple strategies, real results, no fluff. And drop a comment below. Tell me, what has been your biggest fear or confusion about investing? I read every single comment and I will personally reply. Your future self is counting on the decision you make today. Start now. Stay consistent. And I will see you in the next one.